It's strategy time, and joining us now from our studios in Cape Town, Rashaad Tayob, Portfolio Manager at Aeon Investment Management. Thank you so much for joining us. Great to have you on the program. This week we saw inflation coming in slightly higher than most had expected at 5.7% year on year for the month of September. Retail sales also surprising to the upside. Everyone is looking towards where they could find the most returns for the lowest risk right now. Rashaad, give us an indication of where you think we're headed in South Africa. Is equities the place to be right now, or would you be looking at other asset classes?
Well, our favorite asset classes at the moment are, there's four of them. Firstly, in the money market space, we trying our best to get as much yield pickup as we can and mitigate the risk of any interest rate cut that might occur next month. What we really like at the moment is inflation-linked bonds. Everyone knows that we're in a cyclical upturn in terms of inflation, but if you look at how the rand has depreciated 15 to 20% against the major currencies, if it stays there, and our view is that it will stay at these levels, we could very easily see inflation around or above 7% over the next 6 months. We also like preference shares. We think they offer good value in terms of getting a 1% yield pickup above cash, so you get around 6.5%. After tax, on a pre-tax equivalent, you're looking at 9 to 11%, so there's a lot of value there. And then also in terms of equity, we do have equity exposure in our absolute fund, but it's hedged equity, so we protect the downside. And if the global economy does recover somewhat, we're going to get that upside. But if the risks of a downturn, the problems in Europe don't get rectified, we do have protection in order to protect that downside.
Tell us a little bit about the protection that you've actually taken out and how you are protecting yourself from the downside. Give us an indication on your equity investment strategy.
Well, what we do is we use derivatives to provide explicit protection on the downside, but it's not derivatives in any scary sense. It's derivatives as a form of insurance. So if we pay a certain premium, if the market goes up, we get the benefit of a rising equity market. However, we lose that premium. If the market comes down, we get compensated for the downside because we've bought that protection. So we believe at the moment, given the risks and uncertainties you see, we think that's a prudent approach to take in terms of our equity exposure.
Some would say that preference shares are a very interesting way to, of course, embark on an investment. Some say that it's slightly too costly. Give us an indication of which preference shares you prefer right now.
At the moment, we like the preference shares of the big four banks, so Standard, Absa, FirstRand, and Nedbank. I mean, a lot of retail investors got burnt in preference shares a few years ago. But the important thing is to focus on the yield you're getting. And back when preference shares had ran up, the yield had just dropped to too low levels, and eventually investors got hurt. But at the moment, with the repo rate at 5.5%, you're getting 6.5%, but that's 6.5% post-tax. So if you're an investor with a 30 to 40% tax rate, you're getting an effective rate anywhere of around 9 to 11%, and we believe that that spread you're getting, that extra yield that you're getting, more than compensates for the risk of preference shares at the moment.
Some would argue
a very attractive asset class at the moment.
Looking at the property market, some would argue also the yield differentials there and the growth that you could actually see within investing into listed property, that it's pretty much the same argument there. I see in your diversified income fund, you only have 5% allocated to property. Give us an indication as to why it is so low and whether you're planning to up the exposure.
Well, actually, we've reduced property exposure in the last few weeks. So, I mean, it's a diversified income fund, so we're never going to go buy half the fund in property. Our maximum allocation anywhere from 10 to 15%, so that 5% was a neutral allocation, and in recent weeks, we've actually reduced that to 2%. The yield is somewhat attractive. However, when you look at it look at that yield spread relative to bonds and relative to equities, it's definitely narrowed. So relative to bonds and equities, property is beginning to look a bit expensive. And then in terms of the growth potential, we feel there is a potential in the next 3 to 6 months for property companies to disappoint, where they've consistently delivered 10, even up to 15% dividend growth over the last 2 to 3 years. We think there's a chance that the difficult economic environment can start to impact that. And you've seen that in a few property results, and we think you're going to see more of that going forward, where the growth is actually going to be a lot closer to zero and investors are going to be disappointed in that. So we've actually moved the other way. We're becoming a bit more conservative on the property sector.
Interesting to note, 42% allocated in the diversified income fund to a floating section with regards to bonds. Give us an indication between the play of the short end of the curve versus the longer end of the curves.
Yeah. I mean, bonds at the moment, we held a 20% exposure to bonds, but once you had that rundown in yields close to 7%, we reduced that quite drastically and moved that into floating rates. We like the money market at the moment, even though yields are low, 5.5%, but what we try and do is we try and use yield pickup strategies, so term premium, credit pickup strategies to try and get that up to, say, 7%. And also try and mitigate the effect of any potential rate cut. We think it's going to be a close call at next month MPC. At the moment, the market is not discounting. They're looking at only a 20% rate cut, but we think it's actually close to a 50-50 next month that the MPC could cut rates. And if they do want to cut rates in order to support the economy, we think that this is actually the last opportunity they have, because next year, with inflation going to be well above 6%, they're not going to be able to justify a rate cut into next year. So November's the last time I think they have the opportunity to cut rates.
You're saying that you quite like those inflation linkers, and it seems that it has been one of the favorites with many investors out there. 10% allocated to inflation linkers. Are you planning to up this at all, given the fact that as you say, a rate cut imminent perhaps, and also we could be out of the target band well into next year?
Yes. I mean, our view is that we're looking to take it up towards 20-25%. At the moment, there's a lot of supply of inflation linkers coming, so we've held off on that decision. But from an inflation outlook perspective, we definitely believe that the rand is going to take its toll on inflation. People are thinking inflation is going to get up to that 6% band, but definitely there's a good chance of it getting to 7 and above. And if you look at a 7% inflation, the real yield at 2.5%, you're looking at anywhere from around 9 to 10% return, which is very attractive in this environment. You also look at inflation-linked bonds offshore. Their yields are pretty much around zero. I mean, the US just slightly above zero, around 0.2%. The UK negative real yields anywhere from minus 0.5% to minus 0.2%. It just from that relative perspective, locking in 2.5% when other people are being forced to lock in negative real yields, 2.5% looks pretty attractive.
Interesting to note as well, just looking at the returns year to date, you've actually seen a return of 6.89%. Your benchmark, which of course is the Steffi Call Index, experienced a return of just under 4%. So you have outperformed the previous month, so September, a slight outperformance there, but still pretty much 0.5% to the good. Do you think that you can actually maintain this momentum, that you will end the year significantly higher than your benchmark?
No, we, for every asset, for every strategy we look at, we're always very cognizant of what the benchmark is. So everything we analyze, if we like inflation-linked bonds, we have to look at what's the upside relative to our cash benchmark and what's the downside. And the asset classes I've talked about in terms of the money market, the credit space, the inflation-linked bond, and the pref shares, we definitely believe over the next 6 to 12 months, they have potential to outperform the benchmark, and we're confident of delivering over time 2 to 3% consistently above the cash benchmark with minimal downside.
Rashaad, I mean, also just perhaps looking at what's happening in Europe and the US and concerns about China and growth, how is this portfolio going to protect one's capital if we do see a massive blowout in Europe, if the no decision comes to the fore this weekend or even by the end of this year?
Okay, in terms of the income fund, it doesn't have any equity exposure, so it's conservatively positioned. It won't have any impact if you have any negative equity fallout. On the absolute return fund, we have equity exposure, but it's fully protected. It's difficult to understand what's going to happen this weekend. We've seen a lot of conflicting signals, and our view is that I think Europe hasn't quite realized that they have, all the parties haven't realized that it's a very simple choice they have to make. Germany has to decide whether they want Greece to exit the Eurozone or they want to subsidize Greece. They think that there are other options on the table, but in fact they have to make the choice between those two options. And Greece has to decide whether they want the stability of staying in the euro, so the macroeconomic stability, but also the pain, or they want to go it on their own and have maybe run in a higher inflation, a bit more unstable environment, but maybe it might be politically more palatable at this point in time. So each party has sort of two distinct choices, and over the last year we've just seen a whole lot of uncertainty where they're unwilling to confront the fact that they have these two tough choices to make. And even in the last week or two, you haven't seen any strong indication that they're willing to make these tough decisions. So I think it's good to remain conservative, have protected exposure at this time, because there could be further downside coming.
Rashaad, it seems that you're slightly conservative, as you alluded to, and perhaps taking a cautious approach towards the future, because there are many unknowns. But you mentioned the fact that the Diversified Income Fund is largely protected to any occurrence that happens globally. But if we do see a massive blowout in Europe, that could mean that a lot of liquidity could flow out of the country, and we could actually see a much weaker local currency, and our bond market, which has been enjoying foreign inflows for some time now, that could all be reversed. How would that then impact your fund?
Well, I mean, we've reduced bond exposure quite a bit in line with that conservative stance. So whereas we were sitting over 25% in bonds, we're currently sitting at about 6 or 7, and we've moved most of that into floating. So if you do find a risk off scenario where people continue to sell the rand off and bonds get sold off, this fund won't be impacted by that, but rather we would see that as an opportunity if you do have a sell-off to buy bonds at higher levels, maybe closer 9.5%, if that type of risk case materializes, there'd be a lot of opportunity for this fund to pick up yield and deliver returns in that scenario. So it is protected, and rather waiting for opportunities to materialize.
Wonderful. Thank you so much, Rashaad. Great to have you on the program.